Thanks for joining me, Tim. Fantastic to have you in this call. You're obviously managing the JP Morgan European Growth and Income portfolio. So exciting times, 2025 for Europe. We've actually seen the European market perform quite well. We've seen the euro currency perform quite well. From us on the other side of the world, it appears that there is some money flowing out of the US dollar, out of US assets, and Europe's found itself in vogue in terms of equity markets and in terms of the currency. Tell us what you're seeing in the regard on the ground in that regard. Are you seeing those same sorts of signs, and do you think that will continue?
Yeah, Europe in vogue. I mean, that's not something we're used to saying as a European portfolio manager, but that probably sums it up quite well. We are seeing it on the ground. I believe last week, for example, was the strongest week of inflows into European equities in the past 8 years. So, that's a good tangible data point of it. Certainly, we are seeing more incoming from clients. We're getting more opportunities like this to come out and speak about European equities when it's been very difficult up against the strength of the US market, the interest in the Mag 7, really to get your voice heard. And I think a number of things have kind of come together to put Europe back on the map, so to speak.
In Germany, tell me more about this less conservative fiscal policy you're seeing out of Germany, because that's a huge story. And I think if it wasn't for Liberation Day and the tariffs sort of overshadowing it, that would really be one of the biggest stories of the year. So what does that mean for the European markets? What does it mean for you as an investor in terms of your opportunity set? And what does it mean for growth across the region?
Yeah, I think you're right. It's huge. I mean, it's huge as a symbol. It's huge in its economic importance, because essentially you've got the most important economic country in Europe, the one that is probably most in need. I think most people are aware of the structural industrial challenges in Germany. It's the one that's historically been very fiscally conservative, but it's importantly, it's the one with the fiscal headroom. It's the one that had the credibility with bond markets to go and do this. So it's the perfect country doing the perfect thing at the right time. And I think, what does that mean? As I say, I think it's very important for sentiment in Europe. First, we had the Draghi report. Then we had some positive signals coming out of other policymakers through Europe. Now we've had Germany stepping in, and there seems to be a real recognition of some of the structural challenges in Europe, some of the competitive responses that need to be made, and an importance around Europe's place in the world, particularly around defense, for example. How does it play out in the market? I think probably a bit more slowly than we would like in terms of how it comes through in earnings, because what we've almost become accustomed to is, if you take, for example, the US pandemic response, when they had a big stimulus, that was cash given straight to consumers. They go out and spend it. You see it straight away in company earnings. You unfortunately also see it straight away in inflation prints. I think what's likely to happen in Germany is this is more about structural reforms over the long term. And so this will play out over multiple years, but in a slower way. And I think we should be encouraged by that, because it means the duration of earnings growth is then longer in Europe, but we don't have that same spike. We probably don't fall into the same inflation problems. And as I was saying, I think it's targeting exactly what we need around structural reforms, around infrastructure, around competitive frameworks.
And turning to that other big story that has been dominating markets, tariffs and US trade policy. No one knows how this will end or where it goes from here. It does feel like a very uncertain environment, but how are you navigating that? And what are you doing with the portfolio to take advantage of any opportunities or protect yourself from any negative impacts? Are you seeing winners and losers in different sectors? How are you approaching all of that when it comes to running the portfolio?
Yeah, I think the main thing we are trying to do, and we're lucky in that this isn't the first period of volatility we've experienced. Certainly over the past 5-10 years, when you think about Brexit, the COVID pandemic, the Russian invasion of Ukraine, we've had a number of moments like this, and this is quite acute, as you mentioned, and it's really dominating everything at the moment. But what served us well in the past is to be as balanced as we can be. in the portfolio. You're never going to hedge out every risk. But what we want to do is have a balance between stocks that will perform in different market environments, but just own the best for that market environment. And the thing to remember about the tariffs is it's actually been playing out for quite a while. So, there's winners and losers, as you mentioned. There's clear winners and losers, but those tariff exposed baskets, they've really been underperforming since last summer. As the probability of Trump's election started to become more probable, those baskets were underperforming all along. Then through inauguration, then as he started saying more combative things around tariffs, again, they continued to underperform. So it's played out. I'd say the market is well aware of the winners and losers. Now, I think as we would see it, is it's about being balanced to being the two-sided risk, because really we don't want the success or failure of our portfolio to be driven by what Trump says next, because we don't have insight into that. That's not where we're going to add value to our shareholders. So we are trying to be balanced. Again, as I say, something that served us very well, and trying to be balanced to owning names that could benefit from both sides of it.
And something else that's getting a lot of attention in markets is the potential for an economic slowdown in the US as a result of the tariffs themselves, but I think also that uncertainty from businesses, consumers, investors simply being reluctant to act or do anything. So if that did play out in a negative way, if we did see a recession in the US, the world's biggest economy, even a mild recession, how do you think that would impact Europe? Do you think Europe as a region would be insulated? Would it be immune? Would some of these positive things that we're seeing develop offset any sort of US slowdown? What do you think on that front?
Yeah, I think you're right on all front in that we're almost already seeing that because of that uncertainty. When policy uncertainty is this high, corporates don't want to spend on capex; they're delaying plans. So we're already seeing that, and it's about how long that continues. And until we have some uncertainty, the longer that goes on, then the more likely we go into a recession scenario. And I think the old adage was always, when the US sneezes, the world catches a cold, and Europe is part of that. I think what our belief now is, the US is certainly doing as much damage to themselves, or probably more damage to themselves than they are to the rest of the world, through these actions. So, and if anything, I think Europe as a region is relatively better off than some of the other regions that we talk about, the US and China, for example. But how impacted they will be to do with some of those things you mentioned. What is the fiscal response? I think we've already shown some really positive signals from European policymakers on that front. But do we, how can they accelerate it, for example? The monetary response, again, I think the ECB is probably in a better position than most central banks to kind of to loosen and to counteract some of it, and generally some of the structural reforms. How united are Europe going to be, in the face of this? Do we have trade diversion to other regions? Do we become more centrally focused? But certainly, again, to reference back to some of the supply chain problems we had through COVID and Russia, Ukraine, and the energy response, we have seen the reaction function of European companies in times of crisis being very good. And so they've almost had some practice of these kind of war rooms. What do we do now? I think that's been happening for a number of years now. So I think we should expect European corporates to react well to this. And as I say, I think the fiscal and monetary side should support the European economy.
Just taking a step back from some of these worries and issues that are very prevalent in the here and now, and thinking beyond 2025, 5 years out, 10 years out, because you are a long-term investor. So you're not buying companies for this year, you're buying them for the long term. So I just want to get your thoughts on which sectors of the market are the ones that stand out the most to you as good opportunities on that sort of longer term lead time. And are there any stocks that you could maybe highlight to just give us an example of which companies maybe which companies reflect all the things you look for in a business?
Yeah, Yeah, well, that's a good way of let's start with that because, and thank you for asking the question because we're not getting many questions about the 5 and 10 year view at the moment, as you can imagine. What do we look for in companies that we invest in? We are looking for uh, quality companies, and by quality we mean companies with good return on invested capital, companies that generate good cash flow, management teams that are making good capital allocation decisions with their money. We want them to be attractively valued, and we're also very importantly for us, we are looking for companies that have good operating momentum, positive operating momentum in the business. And I think, if we think about some of the companies that have shown that in Europe over the past 5 years, for example, European banks have been a great example of this. And we can pick any one almost of the whole sector. And probably people will gulp when I talk about European banks having said that we look for high quality businesses, because that wasn't the perception of it. But I think that helps explain what we're looking for. They don't have to be the highest quality stocks in any sector, because usually they're priced exactly for that. What we're looking for, underappreciated quality. Companies that are much better quality than the market is giving credit for, because it's not their valuations, it's not their sentiment. So if you think about European banks, from the global financial crisis, they really, nothing was going right for them. They had this kind of one-way slide in interest rates down to negative. They had a regulator that was right on top of them, probably rightly so. But because of that, they were building up capital buffers. And they were in a much better position then when the interest rate dynamics changed to benefit from that. And sentiment was so low on these. The valuations were so low. People were very quick to kind of want to sell the top, even though that performance has compounded again and again and again. So I think, we, as I say, we could mention a number of names, but that whole sector has been strong for a very long time, and really it's come from, when I think about the quality components, it's building up return on tangible equity back to teens levels. It's having kind of capital ratios that are above what we needed, so that could be then returned to shareholders. And a lot of European banks were returning 15% of market cap a year back to shareholders. So that's, I think, a good example of, they had the momentum that we were looking for. They were very attractively valued, and we identified an area of quality that maybe the rest of the market didn't. That's one example that we are still positive on banks. It's not predicated on rates having to go higher. It's just rates staying at around 2%, a level where banks can generate profitable returns, can grow loans slightly, but payout ratios of 100% and returning that back to shareholders. And then another area, we talked about the sort of fiscal spend that's happening in Europe. One of the areas that's kind of more new to us that we're seeing some great opportunities is in some of the infrastructure exposed names within Europe. So, for example, a SPI is a European small cap, although I think it's just grown out of the small cap index now. But it's one that shows one of the great things about our capabilities is we combine quantitative and fundamental. So our quant screens over 1,000 companies daily in a rigorous and repeatable way, and it identifies these new opportunities for us in names that probably other people haven't heard of. And then similarly, I sit beside our small cap team, so they're constantly being badgered by me to join meetings or for their view on some of these companies. So, SPI is one that came out for us a year or two ago, which is a multi-technical services operator, and essentially what that is they are a specialist engineering consultant for large infrastructure projects. So they're already benefiting from these energy transition projects. They're now benefiting for some of the infrastructure upgrades that are happening in Europe. And we're seeing that both in terms of the momentum in their order book, the momentum that currently exists within the business, but it's also an asset-light business. It's very high quality. It's still quite unknown in terms of its valuation. So that's another kind of good example of where we're seeing strength today.
Oh, that's great, Tim. Thank you. That's a fantastic wrap up of what's happening in Europe, how you see the economy and the markets playing out, where there are opportunities, and some examples of how you invest. I've just got one final question for you before we let you go, and that is, for all of those investors out there that are really struggling with this uncertainty, feeling a little bit anxious about what they're seeing in markets, any advice for those people? Any sort of message for them from someone who lives and breathes this?
Well, we're all in it together. I would say, again, playing to the mantra that we live by is you just want to be balanced through this, and I think we have, we are, the VIX will show us that we're at heightened volatility today, but we have been at volatile points over the past 5 years, and through all of those periods, being balanced has worked for us, because I really couldn't tell you whether markets could be up 4 or down 4, whether it's going to be led by defensives or cyclicals or growth or value. And I think it's not about a lack of courage to not want to invest behind all that. It's just knowing that volatility and that uncertainty exists, and that you can generate, and certainly how we view it is, we can generate alpha over the long run by remaining balanced. So we shouldn't be deterred by that, by taking too bold a call in one direction or another. So I think in this volatile times, in these uncertain times, it's about that balance, that diversification, that I think is incredibly important.
Yeah, good point. You don't want to be at one extreme or the other, do you? Particularly in a volatile period where you do risk being a little too conservative, a little too negative, and you miss out on some of those opportunities that always emerge during periods like this. So I'm glad you made that point too. That's something we feel is really important. All right, Tim, thanks very much. We'll let you go. Been a great session, so much appreciated, and take care.
Oh, thanks for your time, Mark. Thank you.
For more insights, visit craigsip.com.